Jenny May, markets have dominated the headlines in recent weeks, and when they do, it's easy to get caught up in looking at your balances more than usual. Harry Smith, one of the senior investment managers at Fisher Funds, who are bringing you this segment, is here to talk to us about the perfect storm we've been in and why we need to think about the value of our KiwiSaver like we do houses. Nice to see you again.
G'day,
we say houses, you instantly get Kiwi's attention, but can you just give us a recap and maybe some context as to what's been going on?
Yeah, I'll certainly get to what's been happening at the moment, but if I just give you a little bit of context and we put it against history, you know, over the last sort of 100 years in the US stock market, the average fall from high to low per year is actually 16%, which is quite a lot, right? But in despite of that, the average return that investors have received has been 10%. And that's where the famous saying, it's time in the market, not timing the market, comes from, right? So if we take it back to where we are today, the US stock market is off around 8%, I think, at the moment. And there's a few reasons for that. One is, I guess, the AI trade as well. We had two fantastic years in the US market in 23 and 24, where the US stock market was up over 20% in both those years. And so some of the steam has come out of that AI trade. There's been some questions around the strength of the US consumer at the moment. And then lastly, which I'm sure will come as no surprise to you, Chris, the Trump administration has created an environment of uncertainty, which makes it hard for businesses to plan and invest. Yeah, but if I bring that back to what I originally said, like volatility is not unusual in the stock market. A 10% pullback should happen every sort of 18 months. And I think the last one in the United States was in March 23. So I don't think what we're seeing here is actually that out of context when you look at history.
Okay, it certainly had us looking at balances. Where do house values come into all of this?
Yeah, well, I think of it the same way I told you there, comment around it's timing the market, not timing the market.
Yes.
I think around the same way as for your house, right? You go and buy a house, it becomes your home, you live in your home for a long period of time. You don't think about how the price of your home has changed on a daily basis depending on consumer confidence, unemployment data, or what interest rates are happening on that day. Now, all of those factors will change the price of your home, but you don't think about it, right? And then because you've lived in your home for quite a long time, in most cases, when you come to sell it for whatever the reason may be, perhaps you're upsizing, you're downsizing, you realise a very handsome capital gain. And so, like, I think Kiwis should think about their KiwiSaver in much the same way. You need to be in the right KiwiSaver for your ability and your willingness to take risk. But it's about timing the market, not timing the market.
Okay, so for those who are hearing that and still feeling nervous, what should they do?
Well, first off, I would always encourage people to reach out and speak to someone and just use them as a sounding board to get some advice and just make sure you're in the right position for you. But it is always an interesting one, isn't it? You have a fall in the market, in the stock market, so 8% in the US, which actually means that risk has come out of the market. So that actually implies it's not as risky as it was when prices were higher, right? So it's actually it's fighting our emotions. Don't let your emotions take over and pull you to make a bad decision. So that would be what I would say.
Yeah, always easier said than done sometimes with the emotional side, isn't it? Harry Smith, Senior Investment Manager from Fisher Funds, thank you so much for joining us this morning.
Thank you, Chris.
I like that, Harry. It's time in the market, not timing. All right.